We are standing by for the announcement from the Reserve Bank on interest rates. Most economists are expecting a rise of 0.5 percentage point, which would bring the cost of borrowing to its highest level in 7 years. Joining me in the studio is finance reporter David Chow, and outside the Reserve Bank is our senior business reporter Peter Ryan. David, to you first of all. So it would be a surprise if there wasn't an increase of 0.5% in the next few minutes.
Yeah, that's right, Ros. Pretty much most people are expecting that magnitude of rate hike. So when we looked at the Bloomberg terminal, 27 out of 30 economists are betting it'll be a 0.5 percentage point increase, essentially another double rate hike. But, you know, there is a small chance it might go increase rates by a bit less than that, which would surprise most of us.
So when would we expect to see rates peaking?
Well, that's the million-dollar question, and we're forecasts all over the place. So if we're basing it off market expectations, they reckon the Reserve Bank will keep hiking interest rates aggressively pretty much every month until the middle of next year, which would take rates from where they are, which is 1.85% to 4% almost by the middle of next year, before it starts to cut rates after that, because by that point it might inflict too much economic pain on the Australian economy. Whereas you have some economists, say from Commonwealth Bank, who reckon it'll peak at around 2.5% towards the end or early next year.
So the trick for the Reserve is how to curb inflation without pushing the economy into recession. How precarious a situation are we in right now on that?
Oh yeah, like getting there is extremely difficult, and in the words of the Reserve Bank governor himself, he said that it's going to be a narrow path to get there, to bring inflation down and have the economy still on an even keel. It's a very hard job, and I don't envy them for doing it.
Let's go to Peter Ryan, who is standing outside the Reserve right now. Hi Peter. So have the rises we've already seen had any impact so far on inflation, which of course is the whole point of the exercise?
Well, Ros, when it comes to the Reserve Bank, it's not how quickly they raise the cash rate, it's how quickly inflation comes down. And we know that inflation is going to be hitting 7.75% by the end of the year, maybe a bit above that. But the Reserve Bank and also Treasury think that inflation might start edging down, maybe towards 5% by midway next year. But no one really knows, as David says, how far the Reserve Bank will go with raising the cash rate. And it's a terribly difficult thing to calibrate, because by pushing too far, pushing too fast, going with too big a hikes, the pressure on borrowers is going to be too much, and also small business, even though it is good news for people with money in the bank, in particular those self-funded retirees. But the last thing the Reserve Bank wants to do is to push Australia into a recession as it cools the economy by moving too quickly and too fast.
What's odd though, Peter, is that there hasn't really been much change in consumer spending despite the rate rises that we've seen so far. Is that very typical consumer behaviour? Does it take a while to change spending habits?
Yeah, look, we're only pretty much halfway through the Reserve Bank's work at the moment, and it does normally take around about 3 months for those interest rate rises to really impact consumer behaviour. But we have seen quite strong, surprisingly strong retail spending. People don't seem to be too worried about going to the shops or going to restaurants. Remember, this time last year, lockdowns were underway, so people are making the most of things while they can. But those interest rate rises are going to start to bite quite heavily, particularly for people who've borrowed at very, very low rates, and in particular for those who are now having to move off those fixed rates into a new higher rates world, and that's where the rub is going to be hitting the road, I'd imagine.
And there's no question, Peter, that the banks will pass this rate rise if it happens as it is expected to, that they'll pass it on to their clients and customers in full.
Most likely. This time a month ago, it did take the banks a little longer than usual to work out who was going to be the first mover on that. But yeah, generally the banks have been under so much pressure, their margins have been shrinking over the last few years, that they will be passing on what they can, but also having to determine how much they pass on to people who have deposits with them, because they have to keep those customers happy at the same time. So I guess when the interest rates are rising, you're not going to be keeping the majority of people happy.
So it is 14:30 Eastern on the dot. Let's go to David Chan now, who's monitoring the Reserve Bank website to see what the action is there.
Well, Ros, I am hitting refresh furiously on the Reserve Bank website, and it is, as expected, an increase of 0.5 percentage point, which takes the new cash rate to 2.35%. That's the highest level in almost 8 years, highest level since December 2014. So, look, I guess the Reserve Bank did meet market expectations in this regard. And, pouring into the decision of the Reserve Bank, it's interesting to study the last paragraph because, from month to month, it doesn't change that much apart from really the final paragraph. So the Reserve Bank says the further increase in interest rates today will help bring inflation back to target. It's targeting 2 to 3%, it's currently around 6%, and create a more sustainable balance of demand and supply in the Australian economy. So, the Reserve Bank governor goes on to say price stability is a prerequisite for a strong economy and sustained period of full employment. Now, the board expects to increase interest rates further over the months ahead, but it's not on a preset path. So that's something it keeps emphasising, that it doesn't have a motive in mind. It's just going to look at the data to see whether it's strong or not to determine what the size of the next rate hike will be. And on that note, let's bring in the point of view of an economist, Ivan Cahoon from NAB. He's a chief economist of the markets division. So, Ivan, since May, the cash rate has gone up from practically zero to 2.35% this afternoon. Can we expect the RBA to slow down or pause its rate hikes from this point onwards?
Look, not stop. The final paragraph, which I absolutely agree with you, if you want to know what they're doing, you read that paragraph. It is a bit different. It does talk about some further increases in the months ahead, but previously, last month, they were talking about being on a process of normalising interest rates. This time, they're not actually talking. They don't use that normalisation term. And they used it twice last month. So perhaps the first phase of getting interest rates to a more normal level is complete, but they're still saying they're going to have to do some more because, of course, inflation is way above their target, and their very final line is they are committed to doing what is necessary to get inflation back to target. So some more to come. We have been thinking that they might slow back down to 25 basis point increments going forward from here. My very quick reading of the statement inclines me to think that way as well.
So, Ivan, before I just outlined the market forecast, they're expecting RBA rates to go to close to 4% by the middle of next year and then rate cuts afterwards. Do you think that's an extreme forecast? What's your view on that?
Yeah, I do tend to think it is a bit extreme. I understand that our rates get dragged around by what's happening to US interest rates as well. So that's part of the reason our rates are so high. But as the preamble to this interview was, we've moved rates a long, long way already. So it's 2.25% in 5 months. It does take time for that to feed through into mortgage repayments. If we get another 0.5%, say before Christmas, that will nearly be 2.75% of an increase in rates in 7 or 8 month period. If you're on a $500,000 mortgage, that's about $15,000 extra in interest payments, which is over $1,000 a month. So that's not that's not a small amount of extra money that households with mortgages have to come up with. So to get to 4% by the middle of next year, I think if it happened, would have a very dramatic slowing in the economy. Because it's such a big quantum, I think it's a bit too quick or it's a bit too high for Australia.
And Ivan, we've got to consider what's happening overseas, where things are looking a bit bleak. The US, UK and Europe look like they're heading towards recession if they're not already there, while China's economy is slowing down rapidly. Can the Australian economy continue to grow and avoid an economic downturn if those other economies are suffering?
Well, I think the backdrop obviously is slower world growth, and that always has a impact or flow through to the Australian economy. So you would be saying starting point is slower global growth. It's not as helpful for our economy. I am encouraged by the Reserve Bank still wanting to, tread tread the narrow path between getting inflation back down to target and keeping the economy growing. That's a challenge. It's a very big challenge at the moment because inflation is so far above target, and also because we're tightening interest rates, not ahead of inflation picking up, but behind inflation or after inflation's picked up, and with those lags we've talked about. So it is a big challenge for the Reserve Bank. We're expecting that towards the end of the year, probably by November, they might pause and have not move rates in December. So they'll be able to look at the data over November, December, January, come back in February and see if more tightening is required or not. And also the backdrop is other central banks around the world are moving rates up sharply. So to some extent, we could probably hang on to the coattails of those central banks as well.
Ivan, thank you very much for your insights.
Thanks, David.
So that was Ivan Cahoon, Chief Economist from the Corporate and Institutional Banking Division of NAB. Ros?
Thanks, David. So just a reminder, as expected, the Reserve Bank has lifted the cash rate by 0.5 percentage point. Let's go back to the Reserve Bank now and to our reporter who's there, special business reporter Peter Ryan. So Peter, the bank always puts out a statement when it makes an interest rate decision like this, which lays out their thinking for the move. The final paragraph in that statement seems to be crucial. Just remind us what clues it gives us about future rate rises.
Well, Ros, my reading of this is that the Reserve Bank is in a little bit of a wait-and-see phase at the moment, even though they have they've said before that they're going to do what it takes to get inflation down. But the statement's saying that a continuing source of uncertainty continues to be the behaviour of household spending, noting that the higher inflation and higher interest rates are putting pressure on household budgets, but they say that the full effects of the earlier interest rate rises and higher inflation is yet to be really seen. So the Reserve Bank will be waiting to see what the impact is, particularly as we have seen some measures of consumer confidence falling, but at the same time wages are growing. Companies are reporting it's very hard to find the right labour. They're having to pay more for it. That's only adding to inflation. Additional to all of this, we're yet to see the impact of the fuel excise going back to its full level after having been reduced. That will be adding towards inflation. But Ros, once again, the Reserve Bank's made it pretty clear that there are more interest rate rises ahead and that they will be doing what it takes to get inflation under control.
And Peter, you said that we should expect the banks to pass on this cash rate rise in full, variable rates to increase, that is. But last time, banks cut fixed rates. Could we see that this time round?
Well, it's possible. We're actually seeing a fair bit of competition between the big banks at the moment in terms of variable rates, while, you know, people who are looking for fixed rates will find them a little bit higher at the moment. But banks have seen their margins tighten up, so they're scurrying around looking for opportunities to pick up new customers. So anyone who's coming off a fixed rate or unhappy with the current deal they have at the moment, well, as treasurers and advisors have said over the years, get the boot leather wearing out and shop around and get the best possible deal. But one of the big pressure points at the moment will be people who are rapidly or about to come off fixed interest rates. They're going into a higher interest rates world. Some of those borrowers are going to be finding it harder to negotiate a new loan, given that the banking regulator, APRA, is now saying that there has to be a 3 percentage point buffer, or borrowers have to show they have the ability to repay at interest rates 3% higher. Not so long ago it was 2.5%, so those requirements have changed. So there's going to be a lot of pain from those people coming off fixed rates, even though at the time they felt that they were getting the best possible deal, taking into account that the Reserve Bank Governor Philip Lowe had said late last year that interest rates would remain low until 2024. And just before I go, in terms of what happens next, tomorrow we'll be seeing the latest economic growth figures, or GDP. That's likely to show that the economy is actually running pretty strongly at the moment, and whether or not that's a bit too hot for the Reserve Bank, well, we'll just have to wait and see.
OK, for now, Peter, thank you. We're taking you now to Canberra, where Treasurer Jim Chalmers has responded to the RBA decision.
Mr Speaker, the Independent Reserve Bank has just announced its decision to increase interest rates by another 50 basis points, and that brings the cash rate to 2.35%. Now, this will be very difficult news for a lot of Australians with a mortgage. Once again, it isn't a surprise to anyone. The bank had flagged more increases, the markets had anticipated it, and homeowners were expecting it as well. But the fact that we knew it was coming doesn't make it any easier for people. This is tough. This will tighten the screws on family budgets. This will put more pressure on a lot of Australians who are already stretched enough. Now, as the House would be aware, a half a percentage point increase in the cash rate means that average homeowners owning $330,000 will have to find about $95 a month more for repayments. For Australians with a typical $500,000 mortgage, it's about an extra $145 a month, in addition to the extra $475 they've had to find since rates started rising before the election in May. So interest rate rises do mean that Australians will have to make more hard decisions about how to make ends meet. And it also means more difficult decisions for governments, because higher interest rates mean a higher cost of servicing the $1 trillion of debt that has been left to us. Now, as I've said previously in this place and elsewhere, it's not for the government to interfere with the independent decisions of the Reserve Bank. It is our job to do what we responsibly can to help Australians deal with these pressures in the near term and to build a much more resilient economy into the future that is able to withstand some of these global and domestic shocks. And our Jobs Summit, our economic plan, our budget, they're all deliberate and direct responses to these economic circumstances that were left to us. High and rising inflation, flat and falling real wages, and productivity paralysis. That's why we're doing so much to ease the cost of living, whether it comes to childcare or wages or medicine costs. It's why we're working so hard to deal with the issues in our supply chains, which the Prime Minister mentioned in response to the question from the member for Kennedy. All along, Mr Speaker, we have been upfront about the nature of this inflation challenge. We've been realistic about the decisions taken by the Independent Reserve Bank, and we will continue to work around the clock to make this economy more resilient so that Australians, especially right now with a mortgage, doing it especially tough, know that the government is doing what they can to deal with those parts of the inflationary pressures where we can have a meaningful influence.
So that was the Treasurer Jim Chalmers there responding to the news of the last 10 minutes that the Reserve Bank has put up the cash rate by half a percentage point. This is tough. This will put more pressure on families, he said. More Australians will need to make more decisions about how to meet the cost of living, and it means more decisions for governments too on how to ease those pressures. Comments there from the Treasurer. Let's touch base again with our finance reporter, David Chow, who's with me in the studio. Hi there, David. So how have the markets reacted to this move? Have they priced it in already?
It seems like it. Looking at the figures on my screen, it seems like the market barely even bat an eyelash. So the Australian share market is still pretty much dead flat. It hasn't really only gone up by like 1 or 2 points to 6,854 points. That's the ASX 200. So this half a percentage point rate increase was very much within market expectations. And we can also look at the Australian dollar for reaction, and it's just gone up by a tiny fraction. It's sitting at 68 US cents, around a 7-week low against the US greenback. And boy, it has fallen a lot since April. Back in April, the Aussie dollar was fetching 76.5 US cents. But I guess, the US has been hiking rates much more aggressively than Australia. That's why their currencies have been appreciating more. And plus, there's all this global uncertainty, talk about certain economies falling into recession. So safe haven demand has boosted the US dollar and weakened the Aussie dollar, which is still at 68 US cents, Ros.
David, thanks for the analysis.
No worries.
Well, today's rate rise is going to impact the cost of living crisis, with many people finding it hard to make ends meet. In these circumstances, food banks offer a valuable lifeline and also a gauge of how an economy is travelling. Brianna Casey is the Chief Executive of Food Bank Australia, and she joins us now. Hi, Brianna. So have you been busier since rates started to rise?
It's been an onward trajectory. It was incredibly busy right throughout COVID. But what we are seeing now is that the cost of living crisis, and indeed the income crisis, is leading people to a more difficult financial position even than we saw at the height of COVID. So we are seeing extraordinary numbers coming through food banks nationally. It's quite staggering.
Are you seeing a greater variety of people coming to you for help, many new clients?
We are indeed. We're seeing a great deal of people who've never had to access food bank or food relief before. We are seeing a large spike in numbers. We were already seeing 1 million people a month requiring food bank services nationally coming into today's increase. The Treasurer is right. This is going to force families to make some incredibly difficult decisions. If we look at how this is biting right across the country, it's hitting us everywhere. We know in Queensland, Food Bank Queensland's member charities are seeing 47% more people per week than they were back in 2020 at the height of COVID. We know that in Western Australia, we've gone from seeing 200 people a day to 700 people a day between 2019 and now. It's grand final season. If we look at the MCG grand final crowd, Food Bank Victoria is going to be feeding the equivalent of an MCG crowd every 2 days. These are staggering numbers. And unfortunately, when we see these interest rate rises adding to the cost of living pressures, with the fuel excise coming off, people are going to be forced into really precarious situations.
So how's it affecting you? Are donations increasing as well to meet demand?
We're seeing a confluence of issues at Food Bank. We are facing those same supply chain pressures that we're seeing in supermarkets. So we are seeing less coming through food rescue. And it means that when we are buying food, which we need to do to get the right food, culturally appropriate, nutritious food to families, when we're buying that food in bulk, it's not stretching as far as it normally would. So unfortunately, where we could normally turn $1 into $5 or $7 worth of food, it's more like $3 or $4 worth of food at the moment, at a time where we've actually got increasing demand for food relief. So it's a really tricky time, and the difference this time around, the big difference now with cost of living pressures compared to COVID, is we don't have those additional support measures that we saw with the coronavirus supplement that really helped. In fact, we saw poverty rates halve for the poorest families, for those single parents through that period. So we do need additional support in the community, and we need it quickly.
So Brianna, what can people expect when they decide that they need to go to a food bank?
We provide a really welcoming environment. We're really proud of the work that we do at Food Bank that recognises that there is no stigma, there's no shame, there's no embarrassment attached to asking for food relief. It's a really brave and important decision for people to make when they are doing it tough. We know people are making impossible choices around electricity bills, around fuel costs, around public transport costs, energy costs and so on. We want food to be one less worry for families to worry about. We don't want people to see asking for assistance as a sign of weakness. It's actually a sign of strength. And when they come to Food Bank, they will find fresh fruit and vegetables, they will find meat and protein products, they will find ambient shelf-stable products that they can put in their pantry to last their family. That's what we're here for, and we're really proud to be helping people.
Brianna Casey, thank you so much.
Thank you.
Let's get final thoughts from Peter Ryan, who's down at the Reserve. Hi again, Peter. So rates are now at 2.35%. How much higher are they likely to go? And do you think we'll continue to see such aggressive rises, half a percentage point, or will the Reserve start to slow its response?
Well, just reading through that statement, Ros, it's looking as though the Reserve Bank might well go back to those traditional increases of 1/4 of a percentage point. But who knows, depending on how inflation goes, the global factors that we're dealing with, what happens in Europe if Russia doesn't turn the gas back on, and those massive energy price surges there. Just listening to the interview there from Food Bank, the pain really is hitting. These monetary policy decisions or rate decisions aren't just about board members sitting around a table at the RBA here in Sydney. It's about what happens to real people who have mortgages. They're worried about whether they can fill the car up with petrol, experiencing bill shock and wondering why they're having to pay the price. And it's incredible to think that this time 2 years ago, we were at the height of the pandemic, where the economy looked like it was heading towards a rerun of the Great Depression. We've come out of that, but the challenges are much harder at the moment. And when you consider that the Reserve Bank was being criticised for not getting inflation high enough, they're now being criticised for not being in front of the curve enough to control it early on and leaving interest rates too low for too long.
Senior business reporter Peter Ryan, thank you for your thoughts.
Thank you.